Hello, welcome all. Let's have our evening snacks or breakfast, depending on which part of the world you're logging into this Zoom call from. And we're having a nice little business recap here because the last time our company got together and talked about the stock market was something like 3.5 years ago, with little bits of conversation in between. But the last full breakdown we had was 3.5 years ago, where we had our get together. So we're just going to have a little refresher now and share the new things we've learned since then. So overall, how our portfolio is doing. Our portfolio is doing pretty well. Let me just bring it up here. Well, I'll bring up something else. Where is it? Our portfolio did well. We invested around like 30K and we made a 30% return in a couple of years. 10K. That's good. 10K. But how did we do it? We did it with safe investments. See what I'm saying? I know off by heart the investments we made. And it's because we use this new little procedure that I invented called the investment backtest. And here it is. There it is. I'm not going to share them because it's too hard with this phone. Wait, maybe I can. Maybe I can. Aha. This is the investment backtest. We have the NASDAQ QQQ. This is the NASDAQ, the tech stocks. 300% return for buy and hold for 25 years. If you were to just hold the QQQ, 8% average year, no compounding. Some years lose 75% when the market goes crap. SPY is less volatile than the QQQ NASDAQ. So that's what QQQ is. These are some key years. I'm showing my intimate data here, so I'll try and skip along while still getting a grasp of it for you. And these are the SPY results. So this is the safer, bigger indices. And this is the UPRO, which is like weight this times double or this times triple. And what I said was you put 70% in SPY, 10% in the triple weighted, 10% in volatile Bitcoin, and 10% in the double. And then it's like this. In the 40% market drop, you blah, 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 blah. However, you gain 2.7, 40% a year with this results. And in a crappy market, you lose just over half. If the market drops 40%, you lose over half. Otherwise, you make 40% a year. Now, let me explain this because this is the crux, the fundamental core of our investment strategy. What it is just index funds, and this is how we invested. We said we're going to invest in the S&P 500. Goes up steady 7% a year, maybe drops 7% a year. 70, big chunk of our portfolio, more than half. Then with a little bit, we're going to invest in the double and the triple. So S&P goes up 7, 10%, this goes up 20%. 30%. But it can go down 20 and 30%. So that's only a little bit, just to add a little bit of extra volatility and extra gains. Because over the long run, the market goes up forever and ever. That's we have history since the beginning of time. That's what has been happening over the long run. But you don't want to be caught with your pants down in the down run. So that's why you don't want to lose a lot of money. So only sprinkle a little bit. You can do this in the 2 times, in the 3 times, in the NASDAQ, tech heavy because it's more volatile, or in Bitcoin, whatever. Just a large fund. There's IBIT, trusts. And I'll give you one more thing. I invested in the jets. It doesn't have to be the overall market. It can be a minor sector like the airlines. Airlines went to crap after COVID. I was like, okay, they're going to recover, but I don't know which one's going to recover. But if I just buy all of them, Jets ETF, that'll go up for certain. Some will go to crap bankrupt. Some will make a booming recovery. I don't know which one, but the Jets ETF is going to recover for certain. And it did. I made 15% in that. So easy. Nice, safe, big index funds. And then every, 5-6 months, you rebalance. So some of your crap went up, but you want to have a big chunk in just the S&P 500, SPY. So rebalance, so you sell some of this and put some more into SPY. To not get yourself too risky and unbalanced. And the last thing you do is you sell peaks and you buy dips. So when the market is doing really well, it's not going to go like that forever. It always goes into slumps, even just minor slumps. So the market goes up like 10%, sell 30% of your shares and just keep it in cash. Market falls 10%, put that 30% in cash back into the market. You just sold a peak, bought a dip. Every 10% change. 10% win, cut it. 10% drop, go back in. And you amplify your results even more than just sitting tight. Other than that, there were some individual stocks I buy, and these are stocks you can find golden opportunity. I only recommend you buy 1, 2, or 3 stocks. That's it. I bought Disney when it was crapping like Netflix and all the other streaming guys. You could have bought any one of them really, but Disney recovered. I made 30-40% in it. I bought Nvidia a couple of months ago when it was hyped up and gained 100%. I said it's going to make some more money. I made 70-80% in that. And obviously when I make that much, I sell the profits. I sold like 90% of my Disney I sold, and 90% of my Nvidia I sold. And I chunked the change. You got to sell when you're up. You can't make infinite amount. You can't even 50% is a lot. That's why you get to 50%, you're done. Sell 90% at 50%. In a couple of months, in 1 year, you make 50%. That's excellent. So it's going to definitely crap soon. So sell some change. Now let's get to some theory. Last time we should talk about theory. Look for, like, when you're looking for individual stocks and your indices and stuff like that, look at the chart. Look at the week chart, the day chart, the month chart, the year chart. And check the trajectory. Look for patterns. Look for, like, if it's like kind of like this, or if it's like this in a range. So if it's in a range, or if it's in a triangle going out or a triangle going down. So triangle going down, if this triangle is as big as the start of the base of the last triangle going up, then you're near the bottom. That's a support zone. That's when you can get back in at a huge discount if you believe it'll recover. And for something really big, it might recover. It'll has a better chance. Like a large indices, a big stock like Disney or Google or Facebook or Microsoft, Apple. And then read some. This is the part I missed out on our last chat 3.5 years ago. Read the news. Read news on the overall market, how the Fed rates, the recession, the housing market, the inflation, the wars, the price of oil, the US dollar. Read all of that. Commodities and bond markets. Read all of that. And then think about the individual stock news. Like if Apple is in a crapper, why is it in a crapper? For me, it was concerning that Apple didn't develop AI. They were the last to start using AI. Everyone was using it. Google, everybody was crapping on AI. And Apple was like, we're not going to do it. We're not going to do it. And then they ended up just stealing from Google's AI and said, yeah, that's our AI. So they don't even have their own still, I believe. So that was concerning for me. Like, you're not investing in the next stage of innovation. So that's why I didn't buy the stock. It was crapping and they didn't have AI. There's no future for that. There's more competition in cell phones. No new products. You got your crappy little watch. You're all overpriced hype. Maybe it's gonna start to level off the stock, and not continue going on forever. Like McDonald's kind of leveled off, and Coca-Cola kind of leveled off, and the airlines kind of leveled off. They reached their peak. They got nothing left to innovate. They saturated the market. Now there's competitors coming in and innovating more than them. So that's what we missed out last time. Follow the news. Remember the big stuff: the housing rate, the inflation, the US dollar, oil, wars, interest rates, housing rates, the Bitcoin, and the government policies, and the elections, and the recessions, and the employment rate, and the crime rate, and you got all that stuff for free, and in the Wall Street Journal, in your news, in your YouTube podcast. There's a billion podcasts on that stuff: finance, money, stocks, politics, all that stuff. Finance, money, politics, business, leadership, just money talks, business talks, finance, economics, stocks. You got all that news at your disposal, and then tie it in with the graphs that you see. So with the graphs, what does the graph look like? That tells you how the stock market is doing. The bigger the graph, the bigger the company, the bigger the market cap, the more significant that graph is. If you look at some penny stock, it's not going to matter. If you look at some small $100 million company, it's not going to matter. But you look at a $100 billion company, $500 billion company, tells you something about that industry and about that stock. So if you look at a 500 billion company and it's going like this, then you look at a 300 billion company, which is in the same industry, and it's kind of going like this. What's going on there? Why is this one? They're in the same industry, 500 billion versus 300 billion. One's like this, one's like this. There's some serious management issues between the two. So that's the strategy we used. We used this big index funds, buying dips, selling peaks, rebalancing, and then just buying like hype stocks, stocks that have dropped and you think you're going to recover, and following along with the market news. See, this was a short lesson of what we learned. And for more data, we can again look at these the same sheets that I had last time. I've upgraded them a bit. I've added some colors and some unique formatting and charts and images and data, more data to them. So we could again look at these documents that I made outlining the thesis. It all still applies. I've just added some more stuff to them. Mainly, I just switched to just holding these index funds. I stopped buying stocks and searching for stocks, and because you can make a good gain. You index fund is 7%. Add some extra volatility in there. Bitcoin, the 2 times, the 3 times, the Nasdaq, and you go from 8% to 25%. And when the market goes to crap, you don't go to crap, because when the market goes to crap, stocks can drop like 80%, even the big ones. And then when they do drop 80%, you buy them. You've only dropped 20%, 30% when the whole market drops. So you have more money now to buy those big stocks that have dropped more than 50%. And then in 2 or 3 months, you make 50% or 100%. You got to think. And look at the graphs and follow the news. And use free stuff. All of this is free. I don't pay for anything anymore. I pay for the Wall Street Journal and like a little bit of charting software so I could like do some technical analysis on my charts. But it's like $100 each. Wall Street Journal like $100, the cheapest version, the student version, I don't know. And the charting software I mean, you could go more complex if you're like doing day trading, but all this is free. You could even practice for free. Even if you have small accounts, you could make good money. If you invest $3,000, you can make $1,000 in 3 years. You can make $300 a year. $1,000, make $100. And with low fees, because when you trade index funds, there's no fees on that. There's very small fees. And then you buy a couple of stocks and to add more, risk reward. And you'll never be in this pit hole where you're down like 50%. Market goes down not more than 10% at a time. In the Great Depression, the market went down like 50%, just ballparking. COVID, the market went down 30%. And that's huge. And but then if you've been selling some, you always have some reserve. So if you've been buying dips, selling peaks, then the market goes to crap. That's when you get in. So if you have any more reserve, you get in when the market goes to crap. And then you're going to triple that money on the way up again. Maximum 6 months. 3 months and you double the money. 6 months and you triple the money. And then you sell again. You cut again. And that's the wave you got to ride, because the market is always up and down. Just got to be safe about it. And then we got some pictures here of my results and examples of case scenarios of our holdings and results. So we could take a look at that and see, just following this same plan. So that was our intimate company group talk. That's what we've learned. Be more safe with index funds. Buy the dips, sell the peaks, use the charts. Read the news. Look for big companies that are doing big stuff on the charts. Buy when they're low. Big companies that are hoping to get back up there. Only a couple of stocks and risky investments. Big guys. And a majority in just SPY. S&P 500. That's what we've learned. So this was a good recap. See you again like 2 years. 2 years we'll have another recap if something changes, but we're on the right path. So, okay. Company report, quarterly report, over.